Hi, I am Jennifer Siegel from Derivative Logic, and welcome to another edition of What I Learned This Month with economist John Rothfield. As many of you know, John has had a long career as an economist and market strategist for Bank of America and also as the Chief Economist and Portfolio Manager for CalPERS, and we are lucky enough to have him join us today. So, John, let's start with the observation that US GDP grew by only 1.5% in the second quarter, and in July, the economy actually lost 23,000 jobs. Are you still gung-ho on the state of the economy and the outlook going forward?
That is a fair question, and appreciate the opportunity again to have a chat with you about what's happened. I have to say, though, that those two numbers, the 1.5% and the minus 23,000 jobs, have to be put in a broader context. So I am still basically quite gung-ho on the economy. A couple of reasons for that. Let's start with GDP. What they call private final demand, which is essentially business investment or business spending in general, plus consumer spending, rose at a rate of 3.9% annualized in the second quarter. That's pretty strong. And it was various other factors that started to subtract from that made the headline number low. For example, because domestic demand was so strong, the imports of products, consumer products, started to increase again. That's a subtraction from GDP. And so there were a lot of subtractions. Another subtraction happened to be the fact that the government drew down the strategic petroleum reserve, which actually was a negative from the government side of GDP. So there were quite a few subtractions from GDP that made a big gap between private final demand, which is ultimately the number that the Fed looks at, what consumers and businesses are spending domestically, forgetting about trade and inventories, and that number was 3.9%. Nominal GDP in the first half of the year, when you take the two quarters combined, grew at 7%. That's prices plus volumes. That's a high rate relative to a Fed funds target of only half of that. And it speaks to the idea of pretty high profits in the economy. Now, there are a couple of mitigating circumstances. You know, when we look into third quarter, the so-called nowcast, which is the one of the Fed's estimates for what third quarter GDP is going to look like, and remember, we've only kind of just started third quarter, we don't have much data. That's starting out pretty strong. That's starting out with another with a four handle on private final demand. I don't think we're going to get there, but that's a pretty strong start to the estimate for third quarter GDP as well. Now, I have a couple of reservations. One is the impact of the World Cup, and we can talk about that a little later on. Another thing that's kind of been understated by economists is the fact that this year the Amazon Prime week was in late June, not mid-July. And as a result of that, Walmart, Target, all these other folks started to bring their discounts and to try and generate more sales into June rather than July. Now, we don't have July retail spending that yet. We get that tomorrow, but we'll get an opportunity tomorrow to see whether there's any cannibalization from June into July, and we get a weaker number in July. But from what I've seen so far from the Bank of America consumer checkpoint for the month of July, consumer spending actually held up very strong in that month. So I'm not too worried about that. Also, a couple of other things. I mentioned there's a recession model that's now shown on the Fred database, which is showing a nowcast showing that we have 0% chance that we're in a recession right now. That's unusually low. 0% chance we're in recession. We also got data out from the New York Fed yesterday that showed that consumer delinquencies and outstanding balances of debt have moderated recently, particularly for student loans because of the end of the forgiveness. We do have a high rate of delinquencies in student loans, but that's a number that can probably be contained to a relative part of the economy. And also, a lot of these people who do card numbers are showing that the K-shaped economy is converging a little bit. lower level income consumers are consuming a bit more. So I'm not really worried about that 1.5. I'd be looking more at the 3.9. Now, on the job side, the BLS survey has been very volatile this year, much more so than two other measures of employment. One is the ADP, and the other one is Revelio. ADP covers about core of the payrolls in America. Revelio data scrapes to come up with an estimate for employment. Both of those numbers were much stronger in June than the BLS number. In July. And the BLS number last July was also weak. So we wouldn't be looking at that one number like the minus 23K as a sign that the labour market is falling away after the World Cup, for example. And I would say that for the first 6 months of the year, ADP and BLS are equal at 72,000 plus per month. So Revelio is at about 50,000. So you look at those numbers and say that, last year we weren't creating any jobs. This year, on average, we're creating 70K a month, roughly 50 to 70K a month, which, given what's been happening with the labour force, is quite a result. And I would say that the big story in the labour market is just the implosion of the number of people who are looking for work. The labour force, which is the population cohort that is looking for work, or even the marginally attached, people who haven't looked this month but would ultimately like a job, that cohort has declined quite significantly. Part of that's due to the ageing of the population and a recent re-estimate that boomers are a larger percent of population than had been thought before, but it's also been a decline in the cohort of any age group, the number of people looking for work. Now, there has been an increase in the number of individual businesses, LLCs and things like that, of people who aren't hiring people. They're probably not registered as in the labour force. So there is some change going on in the labour force. But the bottom line is, when you look overall at the labour force, diminished supply, 72,000 a month for the first 7 months of the year, that's a pretty strong labour market. And the other one that I finally wanted to mention is what I've always talked about on these calls with you, which is the Kansas City Fed Labour Market Conditions Index. That was very strong in July. So it doesn't look at payrolls, it looks at 24 measures of employment in a particular month. It was extremely strong in July, the momentum. Part of that was due to the fact that Fed regional surveys plus small businesses are signaling to the market that they're in demand, they're looking for labour. And with a lag, that will lead to actual jobs down the road. In fact, the small businesses, which had been lagging in demand for labour, have said that their main problem now, and that spiked in the last couple of months, is not being able to find enough labour or enough quality labour. So I think that when you look at those forward estimates and you look at the 6 months or 7 months as a whole, the labour market's doing fine and could actually be doing better in the second half. Now, I know this is a long answer to a question, but I do want to mention one thing that's happening on August 28. August 28 looms larger than actually the next employment report because we get the annual preliminary estimate of the benchmark revisions to population and labour force. And a lot of economists expecting that number to show that employment growth was even lower last year up until March than has already been recorded. However, that to me continues to be a supply phenomenon. The unemployment rate is low and has been falling. And overall, I would say the labour market is actually, given the supply side, has actually been quite solid and is likely to improve in the second half.
Thank you, John. That was a lot of information. What do you think are maybe your top, handful, 1, 2, or 3 things, either that you mentioned or maybe that you didn't, that are kind of encouraging your view of, being a bit more positive on the economy than negative?
Well, one is the tariff refunds. the government has given back $105 billion into the economy from the tariffs they collected from April to February. And there's another 60 billion to go. And by the end of this give back, 40% of the tariffs will be give back. Now, we tend to think of tariff revenue as regression, as kind of it's a regressive tax. It cuts demand and it increases prices. Now, I've just been talking to Rex, the co-owner of Derivative Logic, about this. Rex is making the point that Newsflow is saying that the companies that received the refunds, even though they increased prices when tariffs first came on, they haven't been giving it back. But the point is probably that price increases that would have otherwise occurred haven't occurred. And so that's one element of the tariff refunds. The other element of the tariff refunds is that the budget deficit has started to deteriorate again, because the Congressional Budget Office and the government itself expected tariff revenue. There's going to be at least 166 billion less of that. So that's one big thing, the impact of the tariff refunds, that really people haven't factored into their story about why inflation has fallen and why demand has been so strong. Secondly is the strength of this soft data. We're going to talk a little bit later about why the regional Fed presidents, the feedback they're getting is that the economy's doing fine and there's too much inflation. One of the things is, if you look at the regional Fed surveys from places like Philly, Dallas, Richmond, New York and Cleveland, places like that, and Texas, the activity in the economy, including everything, not only demand for labor, but also capex, sales, other elements of business conditions, have been very strong in the last few months. Everyone has kind of been looking through the impact of everyone's been looking through the impact of the war, etc. They're worried and upset about higher costs that they're facing. And one of the elements of that is the trucking data has been very strong. When Greenspan was chairman of the Fed for that 20 years or so, he loved looking at the trucking numbers because it's kind of like an intermediate sign of future demand. Trucking activity has been very strong in the last few months. And it's been in a situation of constrained supply, so prices have had to go up. But yeah, trucking has been strong, and I think that if Greenspan was still Fed chair, he would be taking a look at those numbers. The third element, which is not so strong, is the recent drop in TSA checkpoint numbers for travelers. So one would have expected, with the World Cup on and people traveling from state to state and everything, there would be quite a lot of activity in domestic travel. And maybe even there was a slight pickup in the number of foreign visitors to the US. But TSA checkpoint numbers have been down in June, July, and the first half of August by about 3% year on year, after having been solid before that. So what's going on there? Is it price pushback? Airfares have risen dramatically. People are taking more local travel for their summer rather than traveling somewhere, because you keep hearing these stories about it costs more to fly from San Francisco to Atlanta than it does to fly to Tokyo from San Francisco, that kind of thing. So I think there's been some pushback. There's been some more domestic travel. People are spending more time in their own jurisdiction. So I don't think it's a big worry, but it is an interesting trend.
That is actually quite interesting. And you mentioned the World Cup. Even though the United States is obviously a very large economy, the World Cup could have an impact here on the macro numbers. And do you know how that has panned out, or have you seen numbers about that?
Well, the first thing I want to say, and this will be verified by anyone who works for Derivative Logic, is before the first whistle went for the first game, John Rothfield, myself, picked Spain to win the whole thing. Unfortunately, I didn't monetize that, but that was one of my best forecasts for the year so far. So we don't have any retail trade number for the month of July versus June. Again, that comes out tomorrow. But we do have from the Bank of America Institute, the firm that both Rex Evans and myself worked at for so long. They have an institute now that does economic derivation based on credit card data. What they showed is that there was some positive impact only in the group stages, which ended late June. So by July, the impact on credit card spending had tailed off a bit because there were less cities showing the knockout rounds, and people tending to watch that more on television than staying at home, etc. Couple of other observations from that is that the spending in the cities like Kansas City, Dallas, states that don't necessarily have huge events like international events like this before, is it tended to cannibalize a bit from spending in other cities, other regimes. So some of that cancelled out. The other thing is that the boost to the US economy would be bigger if there was an increase in overseas visitors resulted from this. What the data shows, the credit card data shows, is that there wasn't really that much change in spending in the US by foreigners in that month. There was a little bit of a change toward younger foreigners rather than older foreigners. So the overall thing is, I would say, yes, the economy is big. There has been some impact, but it's a relative impact within the economy to some degree, and it didn't lead to a massive increase in international tourism into the US, which would have also boosted GDP.
Interesting. Yeah, it certainly seemed, they certainly seemed to make it that there were so many more travelers here, but, as you say, if it kind of is offset by other people not traveling, then, you might not see quite the effect, but I guess we'll get a little more information tomorrow. Mm-hmm. Let's move on to the Fed's dual mandate. We've already discussed the jobs market. What do you think about the July CPI inflation report that came out yesterday, and whether the numbers are giving the FOMC any leeway to hold on rates at the next two Fed meetings, which will be in September and then October?
Coverage of consumer prices has been very politicized. People who tend to be Democrat economists who've been appointed by Democrats before suddenly become extremely worried about inflation, and when you get a low number, they say, well, wait till next month, or the special factors involved, etc. When I look at it, and I'm a political animal as well, but I try to, for investors and people trading in the interest rate market, I try to look at it catholically and look at the data as it is. And so it is true that in the last 3 months, so let's just take the CPI right now, because PCE inflation is out with a lag. And I know the Fed targets PCE inflation, but CPI is meaningful as well. The numbers in the last 3 months are very, very weak. Take core CPI ex shelter. In the last 3 months, that's only risen 1.1%. Supercore, which Bloomberg does, which takes out a couple of other things, that's only risen by 1%. The trim mean for the CPI has only risen at an annual rate of 2%. And sticky inflation, which is things that change prices infrequently, ex shelter, shelter is very sticky, has risen only 1.7%. So all these numbers have a one handle on them, basically trim mean at 2%. And so the question I have is, all of those indicators were very high in the first 4 months of the year. They've been very low in the last 3 months. So what's going on here? So if you take the 7 months as a whole, there hasn't been much change in these underlying inflation measures compared to 2025. But there's been a clear bifurcation between the first 4 months and the last 3 months. There's something called the Inflation Shock Momentum Index that one of the Feds is now putting out. That is confirming that. In the first few months of the year, there were correlated month-to-month increases in prices, so there was upside momentum. In the last 3 months, that momentum has come down. So if you're Kevin Warsh, you're going to say that, well, first 4 months is an aberration. The last 3 months, we're kind of in this lower inflation regime. Again, we don't have to do anything. Democrats and others, Democrat economists will say, well, look at the 7 months, and the jury's out on what's going to happen to the rest of the year. So where do I kind of stand on that? So let's take a couple of things. The war, we don't know about what's going to happen in the war, but I did see a story today that said that the national gasoline price today, mid-August, has never been higher at this late in the calendar year. So who knows what's going to happen to the war? How many more of the pseudo peace talks and reversals are going to happen? But we're in a mode where oil prices are sticky. We're down in the Strategic Petroleum Reserve. We have high crack spreads. We have high profits, pricing power by the oil companies. And so I don't know how far gas prices are going to continue to rise from here, but they're unlikely, in my view, to be falling very much. The second thing, I think, these other things, if the Amazon Prime was early this year, what's going to happen to prices in the next couple of months where they're not trying to aggressively discount? Once the tariff refunds have been paid, what's going to happen to that? That's a bit of a question, but it also says that some of these steady prices may go away later on in the year. And then one of the other thing you look at is pipeline inflation. So mainly the regional Fed surveys, which are showing there still is a lot of pipeline inflation pressure, and also the PPI, the Producer Price Index, which came out today, which showed for the overall number a fairly low number, but when you take core final demand, that rose 0.4 in the month and 5% year on year. So there are still firms facing these high pressures. So the two things I would say is on inflation, on CPI inflation, is that the Fed has time to wait because these numbers have been low. And we still need a couple more numbers to know whether the 4 versus the 3 versus the 7 overall months, how that's going to play out. And there are things from the pipeline, from surveys that say that firms ultimately may have to pass on some more of these cost increases. Now, there's one more thing that I wanted to mention on prices. That is the so-called PCE deflator. That's the one that the Fed follows. It comes out a couple of weeks after the CPI. So we don't even have the July number yet. But the August number is going to be significant. So the July number is going to be, there's going to be an upward bias to that number, because it sounds crazy, but when the stock market is roaring along, the CPI for financial services rises sharply. And the rise has been so much recently that the CPI for financial services is going to have a big July. However, in August, which is announced on September 30, after the next Fed meeting, but it is relevant. In August, the BEA, which does the PCE deflator, is going to revise down historically and now the numbers for prices for computing equipment and also prices for financial services. Because the financial services one is too correlated with the stock market. Stock market's an asset price. They're trying to get to consumer prices. And overall, that will take 2 or 3 tenths off the PCE deflator by the end of the year. So I'm in a watch and wait mode on inflation. I do acknowledge that the last 3 months, particularly on the CPI, have been low, and you've got this downward revision to the PCE coming later on this year. But I see the pipeline, and I still worry about what happens when some of these special factors hold down inflation. So I'm still an inflation hawk, but with less conviction in the near term.
Right. One number doesn't make a whole trend. But thinking back to the previous Fed meeting, the new chair was widely panned for the press conference he gave afterwards, which was relatively uncomfortable. And there were 3 voter dissents in favor of actually raising rates, and each of those individuals posted statements about their dissents. And I think the minutes will obviously give us a bit of additional color, but can you put these dissents in context of the Fed history and what it might imply going forward. It feels very significant, but perhaps it's not as significant as it seems.
Yeah, and that 45-minute press conference, he said right at the start of this thing, I have to do this for the rest of the year. I'm committed to it. It's not going to be until January that I can relieve myself through the recommendations I get from my self-appointed committees that I don't have to do this anymore. He just doesn't want to do it. And as a result, a lot of the words that he used were process words, not words that were related to the economy and the methodology for how to decide monetary policy. It was a very uncomfortable experience by somebody who was giving a speech and taking questions, who clearly going forward doesn't want to be doing that. But it is what it is. There will be a lot of changes to the Fed's communications next year, but the dissent process, which has been around forever, it was around with Greenspan, it was around Arthur Miller and all those guys, Bernanke, the dissent process is still going to be there. And I've actually put in some dissent data in the chart pack that I'll send around later, going through each of the Fed presidents. And it is true that recently, in this highly political world that we live in, that there have been more dissents. Remember, Steve Myron, who's only just left the Fed, he was dissenting every time. Chris Waller, I think, dissented once and has now become more Catholic about monetary policy. But, the number of dissents this year has actually been pretty high, and I think it will continue to be the case. Now, a couple of things. As you say, it is unusual for the three dissenters, in this case, regional Fed presidents, to say why they did it. And they issued formal statements from their own regional Feds. The main reason was that when they do their monthly surveys, firms within the region are saying, we need some relief from these cost pressures that we're facing. And so, that was a big thing for them. And then, one of them basically said, according to risk management, it's better that we hike a little bit now than have to do more later. But it was mainly about what was coming from the regions. Now, another thing to note is that apart from John Williams at the Fed, at the New York Fed, there are only 4 other regional presidents who get to vote. And 3 of those 4 basically were the ones that dissented. Now, from what we've heard, there's a couple of others who would have dissented if they had the opportunity. Austin Goolsbee, who's kind of let's face it, probably a Democrat, and Schmidt from Chicago and Schmidt from Kansas City, they would have voted for a hike as well, and perhaps Susan Collins at the Boston Fed as well. So let's say it had been a vote of 19 people, you may have had 3 other dissents as well. So these family fights that Waller is talking about are probably quite vociferous right now about what the Fed should be doing. And I think that, so I do think that it is significant that these dissents have been happening. Dissents will continue to be published next year. The chair himself is not into communication, but the regionals will still have the opportunity, and they will take it, to talk about why they'll be giving their own guidance as to how they will vote. Now, the good thing for the president and Kevin Warsh next year is that the 4 folks who are going to vote next year, other than the board and John Williams, are going to be a little bit more dovish, but that's another matter. We still have this bifurcation between probably 5 or 6 out of 19 who think that we should be hiking immediately. They certainly did a couple of weeks ago, and the rest. And there's some politicization of the rest through the Board of Governors.
That's very interesting. I guess we'll have to keep our eye on that. Staying with Warsh a little bit, since he took over at the Fed, the gap between the 2-year bond yield and the 10-year bond yield has doubled from around 25 basis points to more like 50. And as we've talked about, some of this recent data has repriced the Fed tightening expectations lower, but the 10-year really hasn't moved. And you've talked in the past about the twin balances constraining the long end of the yield curve. And I wonder what developments this past month have confirmed or changed your view about that.
Yeah, well as picking Spain to win the World Cup, I did mention after the first Warsh meeting that I thought he was dovish enough, or he gave a speech at the central bank conference in Sinter as well, that the curve was going to steepen, the 2 cents was going to steepen again. So at that time, the difference between a 2-year yield and the 10-year yield had fallen to 25 basis points. Now it's back out at 45 to 50. It was 50 basis points a couple of days ago. And that goes to the whole issue of, is Kevin Warsh a sheep in wolf's clothing, to reverse the typical phrase wolf in sheep's clothing? Does he talk tough on inflation, but he's not going to do anything about inflation? Meanwhile, the bond market thinks that inflation isn't licked yet. But if you look at the 10-year, break-evens, they haven't moved very much. What's going on in the 10-year part of the sector is this stuff that I've mentioned before, and why it's so important, and why people who are borrowing in the housing market should be looking at things international as well as domestic, is this issue about the twin balances. So the budget deficit, because of these tariff refunds, the budget deficit is yet again going to be, for this fiscal year that ends in September, is going to be more than $2 trillion. The government is spending more now that we have the highest 30-year bond yield, and 30-year issuance is only a relatively small part of the issuance by the Fed. The 30-year bond yield is now the highest since 2001, at the end of the the 90s boom. We have very high rates there. And if you've got $30 trillion of debt and you're adding at least $2 trillion a year, and we haven't even had a recession, which would lead to an increase in debt issuance because you start getting a falling away of tax revenue, that's a problem. There is another problem. There's a whisper that the administration may do some more tax cuts, another kind of one big beautiful budget bill into the midterms, because they think they're going to lose the midterms. So they want to do some more giveaways. Again, unfortunately, targeted toward the high-end earners who are already voting for them anyway. But there is some talk about that potentially could be the case. The other thing which I think is really interesting is that this intervention with Japan. So the US and Japan have intervened together after 3/11/11, the Fukushima disaster. But the last time they did it for financial reasons was after the Asian crisis in 1997, 98. And that joint intervention was essentially in there to prevent the Asian currencies aggressively weakening and causing those central banks to have to raise rates by more, causing US industry to become less competitive, all that kind of stuff. So, and Scott Bessent, who runs the Treasury, that does the intervention, referred to that episode in 1998. But it really does get down to the fact, and my wife is Japanese, but I have to say the new Prime Minister, Takichi, she may be a Thatcherite, but she's also acting a little bit more like Liz Truss in Britain, where they want to cut the consumption tax for food from 8% to 1% or something like that. And that is a big hit to the budget and will lead to more issuance. And if anything, it makes long rates higher there. And does anyone think they will go at the end of this 2-year period and raise the consumption tax on food again from 1 back to 7? I don't think so. So it's blowing a hole in the Japanese budget, and it's causing the Bank of Japan to start having to move off the dime again. Their interest rate's only 1%. They've got wholesale inflation of 7%. They really have to do more. So I think that is a big issue for treasuries. Why? Because foreigners hold about $9 trillion of US treasuries. The biggest foreign holder still of US treasuries is Japan, $1.2 trillion. Some of that is held by the BOJ, which actually, when it does intervention, unless it uses the Fed's special facility, actually has to outright sell treasuries to buy yen. So that's why Besant wants the Fed to the New York Fed to have to the Fed to have to intervene in that thing. But bottom line on that is, we have to worry about fiscal profligacy in Europe, UK, France, places like that where bond yields are rising. And we also have to worry about Japan as well. Final thing, I know we've run long over time here, I wanted to mention is that this year, a lot of the issuance by the Fed of these bonds has been in treasury bills rather than bonds. That's trying to take the supply impact off the long end of the market. The bills are now 22% of outstanding treasuries. The advisory committee says it should only be 15 to 20%. So there's either going to be turnover risk going forward if they keep increasing the number of treasury bills out there, or accusations of fiscal dominance, where they basically say, hey, you're skewing your issuance to try and prevent the government from having to make hard decisions on the budget. So I would say the long end, we're not going to get that much relief in the long end based upon those numbers. On the trade side, net exports have basically not moved very much. Why? Because exports are so small relative to imports. You need a massive change in the relative rate of export and import growth to get much of an overall change in the net trade balance. And, they've had some gains in things like pharmaceuticals and consumer goods, but not enough to change the overall idea that the US continues to have a persistent foreign borrowing need each year.
Well, thank you. That is a lot of interesting information. Just to wrap up, maybe we could talk about the rate outlook. Kind of what is your expectation for interest rates over the next, 12 or 18 months, and where do you see the biggest risks to that forecast?
Yeah, so the 2-year is basically, when you think about a pivot point for the 2-year rate, you look at what's priced in for the Fed over 1 year, because no one knows what's going to happen after 1 year. So it's really what's priced in for the next 12 months essentially determines the 2-year rate. And the 2-year rate essentially has a couple of Fed tightenings priced in for the next 12 months, 2 25 basis point hikes. So is that likely to happen, or is the market overestimating? I would have two stories to that. I think in the near term, the 2-year rate will come down because essentially the Fed has the luxury potentially of waiting a while. But there is this element of the more they wait, as Laurie Logan said from the Dallas Fed, the more they wait, the more they may have to do later. So if the 2-year rate was to drift lower here for a bit, the next CPI number is low, next 2 PCE numbers low, I could see the 2-year rate declining a bit. But I still think we have significant worries going into next year. The AI boom isn't going away. If you look at the hyperscalers, they're all doing more investment next year than they are doing this year, things like that. So I have two views on that. One is that 2-year could initially rally low rates and then potentially increase next year. There is a third way. In March 1997, Greenspan did a one-and-done hike. Rates had been steady from 96 through to early 97. And then, things were bubbling up in the economy a bit, and he did one hike. He hiked from 5.25 to 5.5. And then he didn't do anything again for another year, and then he started cutting rates. So one and done, we all know that Walsh loves Greenspan. That was his kind of hero when he was initially at the Fed back in the 2000s. There's a possibility of a one hike, maybe in December or something, and that being a one and done. And I don't know what's going to happen there. But yeah, so I would be a buyer of 2 years now, expecting lower rates. But as we get forward toward the end of the year and into next year, we get into the period of a lame duck, maybe Donald Trump in that last year. I would say that there's a risk of the Fed getting behind the curve and having to do more. The 10-year, so the 10-year, so the estimate, the market's estimate for the 10-year rate 10 years from now, it got up to recently as high as 6.2%. And I think about when I worked for CalPERS and we went down to PIMCO and did a course down there. Bill Gross from PIMCO brought out his smiley cup, yellow cup with a black smiley on it, saying we've had a 40-year rally in bonds. Ultimately, we're going to go back the other way. And we have gone back a lot the other way. And I do think that with everything that's going on with issuance, with what's happening abroad, things like that, I do think that I don't know, about 10 years from now, 6.2 is probably too high because we're going to have a productivity boom based on AI. We're going to have a recession between now and then for sure. But I think next year, there's still a tendency for the 10-year rate to be rising because the factors that have caused it to rise this year aren't going away.
Well, thank you, John. That is great. And I think we can probably wrap up there. And if anyone has any questions, you can send an email to us at derivativelogic.com and we will do our best to answer them.
Pleasure to be with you again, Jennifer and Derivative Logic.